All right, now we begin the second half of the adjusting entry material, which covers accruals. Right, so you're going to see a big contrast from what we were dealing with before, because now we're dealing with something where, again, we have economic impact, but we have no previously recorded transactions driving the need to book something. Now, there are a couple of exceptions. There's always troublemakers, and again, not every rule is steadfast, and that's dealing with the concept of interest revenue and interest expense. In both of these, you will note, yeah, there's a previous transaction. Like either you loan somebody money or you were extended a loan, which would, in other words, notes receivable or notes payable is what we're talking about there. So that's what's going to constitute the need, necessitate the need to book something there. But again, if you talk about them, like how do those transactions look? In other words, interest revenue that's been earned but not yet received, it fits the accrual pattern. Interest expense that's been incurred but not yet paid, again, it fits the pattern. So therefore, because of that, we classify them as accruals. It falls under the, auspices of if it walks like a duck, quacks like a duck, and it's shaped like a duck, probably a duck. So that's why we just put it in there, even though it does slightly violate that rule that there is no previous transaction. And so what you have on your hands here is something that you pretty much have a lack of a paper trail, or maybe you have a weak paper trail on your hands. You might have not necessarily nothing, but you just don't have a lot to go on. So that's why they're sometimes overlooked by corporations. Again, failing to do adjusting entries, accrual entries, is one of your drivers of errors in financial accounting, and it's the leading cause of misstatements. And when I mean misstatements, that's either unintentional or intentional, because if a company is going to try to make their net income look more grandiose than it is, well, they're going to do it by understating their accruals of expenses, of course. Obviously, that's the area what we're talking about. We don't really care about accruals of revenue. They're probably not going to try and hide revenue. There's not a lot of incentive for that. But there is an incentive to hide expenses. So because of that, we're going to really pay attention to the previous year's accruals. How did those look of accrued expenses? See if there's any discrepancies. And if there are discrepancies that are explicable, that's fine. But if they're inexplicable, like why was this one here? Like why did you accrue salaries payable and salaries expense? Why was that on the books a year ago? Now it's not here. Oh, because the last day of the accounting period is also your last pay period. Therefore, it's explicable. There's nothing wrong with that. Right, so this is for MST3K. We're going to be looking at these. This is going to be for the end of December 2019. And just so you know, not everything that suggests an accrual of revenue or expense can necessarily be accrued. It's more in the expense half of that's more that you have to be aware of. It's usually not likely that a company's going to come across something that looks like a possible revenue and they can't actually accrue it. In other words, if they've earned it, fine. If they've earned it, they need to accrue it if they haven't yet to recognize it. You'll see that it's the expense you have to look into a little bit more. All right, so first up, we receive $6,500 in utility bills that are all due when? The next month, but they all relate to December operations. So in other words, does that sound like something we need to book? And that would be absolutely yes. Because again, did it relate to the current period? In other words, did we use goods and services? In this case, we used utilities. So yes, we need to book that. So that's going to show up like so. Utilities expense will be debited. Accounts payable will be credited for $6,500. In this case, we're just sort of dumping the $6,500 into accounts payable. And then, whenever we actually pay the bills, we'll use that to set against that. In other words, when we actually pay the bills, it'll be accounts payable, debit, cash, credit. So that's another thing to keep your eye on when you're working with the accruals versus the deferrals, is that you're going to set up some payables and receivables that are actually going to be referenced when either you pay something off or, on the other hand, receive something. So in other words, so that you don't double count the revenue or the expense. So that's an important sub-concept. I think it's maybe not as emphasized as it used to be in the material, but it's there. Right, number 2, wages are paid through December 27th, which is a Friday. Payroll records show that employees earned $5,750 for the last 2 days of the year, 30th and 31st. The next payday falls on January 10th, 2020. So again, I was talking about that timing difference here. So again, we have a discrepancy between the end of the year and when our next pay period is. So answer's simple here. In other words, you ask yourself, does that $5,750 constitute some sort of an expense that's been incurred? And of course it is, because you technically owe the employees for those last 2 days, even though you haven't paid it yet. That's an irrelevancy. So we say it's been incurred but not yet paid. So we're going to book that one. So it's similar sound to the one we just talked about. We incurred the expense. We got to recognize wages expense debit of $5,750, and our offset in this case is going to be to a specialized payable, wages payable. Now you'll notice it's kind of seems like almost random. Like, why do we use like just accounts payable for the first one, and this one we set up a special payable? It's your system. You can do whatever you want. I'm also kind of defaulting with the way a lot of books demonstrate this, right? But we'll talk about some alternatives in a moment. Right, number 3, right, so they completed 7 delivery jobs, 17,500 on the last day of the year. None of these will be in the billing system until next year, so we have a billing lag in our hands. So the question is, was that $17,500 earned in December 2019? The answer is yes, it's just not yet received. And once again, cracks the code as to how we book that. So in this case, we're going to just dump it in AR, so accounts receivable is debited, fees are credited for $17,500. Number 4 is going to be a loan to Kevin's Landscaping of $150,000, secured by a note receivable, but it's not due until when? Till March of the next year, so it's not due until then. But what's happening in the meanwhile? We are earning interest on this. Again, it's interest that's earned but not yet received. So, like I said, it sounds like how you would discuss an accrual, so therefore it fits into the category of an accrual, even though there is a little bit of backstory driving it. So that $1,500 that's been earned needs to be recognized. So it's going to get dumped into, in this case, we will come up with a specialized receivable for this one, instead of just dumping it in AR. So interest receivable debit, interest revenue credit. Now you'll notice there is a 5th transaction here, potential transaction. In this case, it's a customer's thinking of suing the business for damage to an expensive antique cabinet, because it's a delivery business, so you can intuit that they probably, they damaged it, they did something that devalued it, and it's worth $500,000. And again, but the lawsuit remains entirely uncertain as of the end of December. So what are your options there? We're not going to book this because we cannot accurately measure the economic impact of the lawsuit. That's the problem we have here. Again, one of your primary requirements is you have to have measurability. You can't just guess what the amount of the lawsuit is. Is it a total loss or is it a partial loss? So, but in this instance, we might be in the place where we need to footnote the lawsuit as an option. And you'll see later when they talk about liabilities, they'll talk about contingent liabilities. Just so you get a quick primer on how that works. Okay, so if you have something that's measurable, because you can measure the amount that we're going to hit for, and it's probable that we're going to have to pay this, then we would say, yes, you have to book that. Now, in this case, we lack measurability, so even if it was probable, we would still just have to resort to a footnote. That's where we're at. Now, if it was, we can't measure it, and it's possible, again, footnote. The one thing is, if it's remote that you'll have to pay it, you don't have to do anything in that case. So that's the way that the table, like the logic table, works for this. Right now, alternately, instead of, using this, dumping it in AP and dumping it in AR, we could have said utilities payable and fees receivable as just swap those out. Just so that if somebody peruses the books, they know that where those amounts come from. They came from the accrual process specifically, because there's no other time and place that you would ever see those on the books. All right, that takes us to the end of the accrued adjusting entries material. Again, the next video is going to tackle like the next step in the accounting cycle, because again, at this point, we have our adjusting entries done, and so we're actually going to backtrack a little bit back to like step 4. In other words, we're going to look at another instance of an unadjusted trial balance and the adjusting entries, and then the adjusted trial balance. So that's what the next video will deal with, is that step in what we're dealing with here, and then preparing financial statements under that situation there. Again, a little bit more complicated because we'll be dealing with the classified balance sheet versus just sort of the straightforward balance sheet that you've seen earlier. So look for that video next. See you there.